Chapter 6 Retirement Funds and Taxes. The SEC also regulates retirement investing accounts. As a quick reference, here is a brief summary of the Internal Revenue Service's most popular current tax preferred investment accounts. Individual retirement account. Who can open? Individuals. Contribution limits. Change yearly. Currently significantly lower than 401k plan limits. If you're over 50, you can make additional contributions. Investment limitations. You can invest in stocks, bonds, CDs, mutual funds, ETFs, commodities, and other investment funds. We will discuss these more in chapters 17, 18, and 22. Tax benefits. You can put money in this account from earned income without paying tax on it. You only pay taxes when you retire and start making money out of the account. We will talk more about tax implications in a second. Maturity date, retirement age. Roth IRA. Same as the IRA, but you pay taxes on your earned income before you invest it. You pay no taxes once you sell your positions in retirement. Essentially, your money grows and your profits are never taxed. You can effectively contribute more to a Roth IRA because after-tax dollars are worth more than pre-tax dollars. These accounts are ideal for young adults in low tax brackets or anyone else with post-tax cash, and they are open to individual trading accounts you can open independently as a minor. See UGMA and UTMA accounts later for joint accounts. If you think you will be at higher tax bracket when you retire, this account can decrease your overall tax liability. 401k plan. Who can open? Employers. Contribution limits. Change yearly. Currently, one of the highest out of all plans. If you're over 50, you can make additional contributions. Some employers will match or partially match your investment contributions. Investment limitations. You can only hold investment choices made by your employer. This can severely limit your personalized investing in individual stock trading. However, most employers supply market tracking funds that will historically follow the market and mimic its long-term returns. Investment limitations depend a lot on your employer. Tax benefits. You can put money from earned income without paying tax on it. You pay tax when you sell your positions in retirement. Some employers match contributions to a 401k plan. This is a terrific benefit that you should fully utilize your plan's limits when your employer matches. Maturity date or retirement age. Roth 401k. Same as a 401k, but you pay taxes on earned income that you invest. You pay no taxes when you sell your positions in retirement. 457B plan. Very similar to a 401k in terms of contribution limits, investment limitations, tax benefits, and maturity dates. State or local governments must establish these plans. If you invest under this plan, you will receive the ability to invest more money than 401k investors can after age 50. Additionally, this plan allows independent contractors that serve the government to participate. A Roth 457B. A 457B plan, except you pay taxes at the beginning of investing rather than during retirement. 403B plan. Very similar to 401k in terms of contribution limits, investment limits, tax benefits, and maturity dates. Public schools, colleges, universities, churches, or certain tax-exempt charities establish these plans. They offer abatements that lower administrative costs compared to 401k. This saved money gives employers more funds to match your contributions. Roth 403B. A 403B plan, except taxes are collected at the beginning of investing rather than during retirement. Simplified Employee Pension Plan. Who can open? Employees of any size, including self-employed individuals. Contribution limits. Change yearly. Currently almost triple the 401k plan limit, up to 25% of your compensation. Slightly lower percentage for self-employed individuals. This plan has no catch-up contribution bonus. Employers must pay all SEP plan contribution participants the same income percentage compensation. Investment limitations. You open an SEP IRA with your bank or other qualified institution, which then funds employees' traditional IRAs. You can hold your own offered investment choices. Tax benefits. Put money in from earned income without paying taxes on it. Pay tax when you sell positions in retirement. Maturity date, retirement age. Savings incentive match plan for employees plan. This plan is very similar to the 401k plan in terms of tax benefits and contribution limits, just slightly lower. Simultaneously, this plan resembles the SEP plan in terms of who can open the plan and investment limitations. However, the plan has slightly lower contribution limits because employers can deduct matching contributions. The government aims this plan at smaller employers to help you save for retirement. Administrative costs are lower in this plan, just like the SEP plan. This gives your employer more money to contribute towards you instead of a management firm. Thrift savings plan, almost identical to a 401k, but the federal government uses this plan, allows you to contribute pre-tax income towards your retirement. Use them to your advantage to maximize your asset growth. Because of the tax benefits of these plans, they usually carry substantial penalties for withdrawing funds early, punishing those who take their money out of the economy on a tax-preferred basis before retirement age. These penalties are completely removed from 457B plans and increase significantly for withdrawals from simple IRA plans made within the first 2 years of investing. Check with your account provider to see how these penalties can affect your investments if you take an unqualified distribution from your account. Often, individuals find that their early withdrawal fees waived for immediate emergency expenses, home purchases, and other extenuating circumstances. Refer to the following IRS chart for a full list of exemptions to the penalty on early distributions, 2018. Note that you must wait 5 years to withdraw Roth earnings tax-free. Remember that you still pay income taxes on distributions from taxable, non-Roth accounts even when the additional penalty is waived. This is the chart. Most retirement plan distributions are subject to income tax and may be subject to an additional 10% tax. It's a penalty. Generally, the amounts an individual withdraws from an IRA or retirement plan before reaching age 59 and a half are called early or premature distributions. Individuals must pay an additional 10% early withdrawal tax unless an exception applies. The distribution will not be subject to the 10% additional early distribution tax in the following circumstances. That's our left-hand column. In the right-hand column, exception to the 10% additional tax. First of all, there's qualified plans such as the 401k, etc. And then there's also the IRA, SEP, Simple IRA, SAR/CEP, and SAR/CEP plans. Age. After participant or IRA owner reaches age 59 and a half, qualified plans, exception to the initial tax, yes. For IRAs, yes. Automatic enrollment. Permissive withdrawals from a plan with auto enrollment features, yes for both. Collective distributions. Corrective distributions and associated earnings of excess contributions, excess aggregate contributions, and excess deferrals made timely. It's applicable and will be exempt for the qualified plans and does not apply to the IRAs. Death after penalty of the participant or IRA owner. Exception for both account types. Disability. Total and permanent disability of the IRA owner or participant. Yes for both. Domestic relations. To an alternate pay under a qualified domestic relations order. Yes for qualified plans, not applicable for others. Education. Qualified higher educational expenses. No for qualified plans, yes for IRA and personals. Equal payments. A series of substantially equal payments. Yes for both. Employee stock ownership plans. Dividends passed through from an ESOP. Yes for qualified, not applicable for others. Home buyers. Qualified first-time home buyers up to $10,000. no for qualified plans, yes for others, IRAs. Legal seizure of your property to satisfy a tax debt because of an IRA levy of the plan, yes for both. Medical, amount of unreimbursed medical expenses if greater than 7.5% of your adjusted gross income, 10% if under age 65, yes for both. Health insurance premiums paid while unemployed, no for qualified, yes for personal. Military, certain distributions to qualified military reservists called to active duty, yes for both. Returned IRA contributions, if withdrawn by extended due date of return, not applicable for qualified, yes for individual. Earnings on these return contributions for individuals are not exempt. Rollovers. In-plan Roth rollovers are eligible distributions contributed to another retirement plan or IRA within 60 days, where you move funds from one plan to another for simplicity's sake, or perhaps to a new financial institution for lower fees and better investment options. Yes for both. Separation from service. The employee separates from service during or after the year the employee reaches age 55, age 50 for public safety employees of a state or political subdivision of a state in a government-defined benefit plan. Yes for qualified, no for individual. Non-qualified 457B plans. Governmental 457B distributions are not subject to the 10% additional tax except for distributions attributable to rollovers from another type of plan or IRA. Simple IRA distributions incur a 25% additional tax instead of 10% if made within the first 2 years of participation. Qualified public safety employees. The exception for public safety employees who are age 50 or over includes specified federal law enforcement officers, Customs and Border Protection officers, federal firefighters, and air traffic controllers. An exemption is allowed for distributions from defined contribution plans or other types of government plans such as the TSP. Despite all of these penalty-free reasons to withdraw from your retirement accounts early, remember why you established these plans: long-term growth. Try to only invest long-term funds that you know you will not need until retirement. The Universal Gifts to Minors Act and Universal Transfers to Minor Act allow you to start investing jointly with your parents as a minor. These accounts can be great for minors if you do not have earned income, you exceed your Roth IRA contribution limit, or you plan to spend your money in the short term to medium term. Remember, you can withdraw contributions early, tax and penalty free from a Roth while saving for an overarching retirement. But the point of UGMAs and UTMAs is to leave the money to grow until the minor reaches transfer age, discussed soon. In a UTMA account, a minor and their parent can jointly hold securities and cash. At maturity age of the minor, all of these cash and assets in the account transfer to the minor. These accounts offer slight advantages but are generally taxed like normal investment accounts. However, for investors just starting off, these tax advantages give great opportunity for you to start participating in your investing. Currently, the first $1,050 in gains that you realize in this account per annum are tax-free. The next $1,050 are taxed at your capital gains rate as a minor. This tax rate, as discussed earlier, is usually lower because of most child's relatively low earned income. After the first $2,100 in gains per year, your account's unearned income is taxed at the higher of your parents' tax rate and yours. UTMA accounts are very similar to UGMA accounts, except for the more diverse range of assets they can hold and their maturity age, an age set by the state an account is opened in that determines when the assets transfer from a custodial to a beneficiary. UTMA accounts can hold securities, cash, patents, real estate, fine art, and other assets. For stock market investing, these two accounts will both hold the same paper assets. However, the irrevocable transfer of funds and assets from these accounts to their minor beneficiaries occur at different time periods depending on where you live and establish your account, as shown in this state-by-state chart, updated early 2016. Please check with your local institutions. Then there's a chart with all the states and the transfer age for UGMA and UTMA accounts. I'm not going to read them all here, just reference the book and you'll see the chart with all the numbers, and just find whatever state you're in and you'll be golden. Note the boxes marked with NA may be states that do not allow for UGMA or UTMA accounts. Almost all states will allow if at least one of these account types. As an investing minor, check with your local regulations and try to open up an account that will mature when you turn 18, the age when you can open a normal brokerage account or put excess money into a Roth IRA or other investment account. Since most parents out-earn their young children, they are subject to a much higher capital gains tax that you do not want to pay after your first $2,100 in gains per year. When you start investing in a UGMA or UTMA account as a minor, you give your parents post-tax money to invest for you under their name. Because this money and any assets you purchase transfer to your name when you come of age, you may have unfavorable financial aid considerations when you apply for college. See Chapter 7. Additionally, your parents may owe gift taxes on your portfolio if its total value exceeds the yearly gift tax allowance. See Chapter 7. When you invest in ordinary brokerage accounts, you use post-income tax cash. When you make profits in normal trading accounts, the government taxes the money you make. The tax rate on these gains depends on how long you hold your positions and your income. If you hold a position for less than a year, buy to sell ownership period, then you will pay the higher short-term capital gains tax rate. If you hold a position for over a year, then you will pay a lower long-term capital gains taxes. These tax rates change each year as they increase as your gross income reaches certain tax bracket levels. These two tax rates have historically been significantly lower than income tax rates. In any of the normal retirement accounts we just talked about, you do not have to pay income, Social Security, or Medicare taxes on your initial investments since they come out of your pre-tax pay. You can use this to your advantage if you think you will be in a lower tax bracket when you retire compared to while you work. However, you pay income tax on both long-term and short-term final distributions in retirement. Income tax rates, no matter your tax rates bracket, are substantially higher than long-term capital gains tax rates. However, similar taxes on short-term capital gains slightly close the gap between income tax rate and long-term capital gains tax rate. We will elaborate on this tax similarity in Chapter 20. Just remember that you have to pay income taxes on your distributed funds in a retirement account rather than just the capital gains taxes on gains in a traditional account. With Roth retirement accounts, you pay no taxes on gains or initial principal when you withdraw cash for retirement. You can fund these accounts with post-tax income just like normal accounts. Remember that you can buy and sell any positions you can trade in a retirement account without worrying about paying taxes when you make money. You only pay taxes when you withdraw cash. This means that you can actively trade in these accounts without having to worry about taxes until you retire. The only limitation to trading in retirement accounts is that the IRS usually prohibits you from having short positions. We will talk about shorting in Chapter 14. Retirement accounts are great if you are worried that you will be tempted to take some of your profits out before retirement. These accounts force you to follow the rules of disciplined long-term investing for fear of paying early withdrawal fees. In addition, you can easily set up automatic account contributions with your employers to guarantee that you put away enough money every paycheck. Alternatively, retirement accounts limit your financial liquidity in case you want to rebalance your portfolio into an emerging sector that you cannot access in your retirement account. Direct real estate, cryptocurrencies, business ventures, individual stocks in some circumstances, and more. The best thing you can do for your financial future is to put your money into assets. If you own a lot of assets, you'll find it very tough to not be rich. If you buy a lot of liabilities, then being poor is very easy. The stubborn market pays you more and more through dividends and long-term capital appreciation when you own assets. Let it.